Hi, I'm Hunter Hutt, Director of Business Development, and today I'm here with SVP Portfolio Manager Andrew Torres. Today we're here to discuss the recent performance and opportunity set in our alternative investment grade credit mandates. August proved to be another positive month for many asset classes, including credit, as the grind continues. As such, our mandates were able to produce their 17th month of consecutive positive performance. Andrew, can you touch on the main contributors to performance throughout the month?
Yeah, August was a typically quiet month. Not a whole lot of trading activity in the market. A lot of people on vacation. So our main contributors really kind of carry and core assets. A little bit of spread tightening. We actually saw spread widening early in the month, and then post the Jackson Hole, the market finished off with a more positive tone to bring spreads a little bit tighter. So yeah, a little just kind of as you said, a grind month, where we just eked out some carry and a little bit of spread performance.
Thanks, Andrew. How are we setting up the portfolio?
Well, we were in risk reduction mode in August. We touched on this a little bit in our call last month. We did that for a couple of reasons. One was we were a little bit concerned about something unexpected coming out of the Federal Reserve at the Jackson Hole meeting in August. But also we were very aware that September is typically one of the busiest months for new issue activity, and you see a lot more portfolio turnover, and we wanted to make sure that we had plenty of dry powder available to put money to work at what we hope to be attractive spreads.
Andrew, inflation has been a major topic of discussion. However, the worry around stagflation has seemingly become material. Why are we seeing this shift, and how can we help in this type of environment?
Yeah, well, I would say to start with that what came out of the Jackson Hole meeting in August really was potentially a kind of Goldilocks scenario. You know, the Fed alluded to the fact that yes, inflation remains elevated, but they're not too concerned. And meanwhile, jobs are recovering at a moderate pace, but not so fast that they feel they need to withdraw stimulus. So that's a good scenario where the economy continues to recover, and yet the Fed is still incentivized to maintain stimulus. However, we are seeing more recently that inflation continues to surprise to the upside. We saw it even with the jobs report for August that came out this past week in the U.S. Wage growth continues to go up. Jobs remain weaker than expected. Job growth. So and we're seeing that again and again. We're seeing if you look at this chart we're just putting up that you're seeing inflation surprises in the economy continue to outpace expectations, whereas economic surprises are starting to trend lower. So that's a bit of a worrying scenario where you could actually end up with stagflation, where the economy is not growing, but if inflation remains persistent. And that's an environment really where equities are going to struggle to go up, but fixed income isn't going to go up either because of perceptions of increased inflation. So traditional asset classes, typically do not work in a stagflation environment. And that's why we'd suggest you might want to consider adding alternatives to your portfolio.
If you have any questions, please feel free to reach out to a member of the sales team. Thank you, and happy fall, everybody.